Um, I'm not sure.
So remember, cash on cash doesn't really do that, right? Because you're just finding out your exit value at the very end. So it doesn't account for cash inflows and outflows. That's what you're looking at IRR. So you're discounting, right, every single year after accounting for the net flow of cash that's coming in. So that's what IRR is more helpful for. Um, okay, good. Um, what were some ways of changing the IRR and cash on cash returns based on the deal structure that we discussed?
We want to finance it through debt,
Mm-hmm.
gives a higher IRR. Yeah.
Mm-hmm. That's great. That's great. What about earnouts?
The less earnout, the more higher the IRR.
Yeah, same thing, right? So you could structure and manipulate the deal so that you could satisfy both investors and the seller by looking at those trades. Quality of revenue. Why was this important, and what kind of revenue structures were there?
The higher the quality of the revenue, the more excited the investors get. So they want to see what was it, contractual recurring revenue typically, and then you got like non-contractual underneath that, and then just
Nice.
recurring.
Yes, there you go. Thank you. Great job, Logan. Yep. So you got, contractual revenue with cancellation fees, and you got non-contractual revenue at way bottom. You just have, I guess, like one-time based transactions, right? So those are just some of the different qualities. Yeah. What are some businesses with great recurring revenue? Like,
Netflix, rent.
mm-hmm. Yes, yes. Thank you, Enrique. And then churn. What is churn?
It's the rate at which you're losing customers.
Mm-hmm. And then cohort analysis. So this is yeah, this was toward the end of the lecture yesterday. So totally understand if everyone was getting a little bit tired. So you're trying to understand every single year. It's like, so imagine like you got all the customers that became your customers, but broke it down per each time period, right? So this could be years, this could be months, and you broke it down per each year, and you're trying to calculate for in this particular example, right? You're just calculating the monetary amount. It could be also the number of customers. It could be the percentage, starting from 100. And every single year that goes by, you're trying to calculate how much and what percentage of the customers are still with you at this time. So really, really important metrics. Doesn't matter if it's SaaS or just a normal business. You always want to keep track of how you're doing in terms of keeping your customers happy. Okay, cool. Any questions in regards to yesterday's material? We're good. Okay, cool. So let's talk about net dollar retention and impact of churn, right? So let's start with this problem here. What is the problem of calculating churn? Before we do that, what is churn?
It's the opposite of the retention. So people that leave or stop using the product or service.
Mm-hmm. Perfect. Right. So whoever's leaving, right? We're trying to calculate the percentage, right? And there's voluntary churn and there's involuntary churn. Does anyone remember involuntary churn?
Involuntary churn is like if they forget to renew the credit card or whatnot.
Mm-hmm.
So then voluntary is they purpose want to quit or stop the service.
Yep. Perfect. Yeah. Just like as Lai said, someone forgot their credit card or couldn't log into their, account, their email address changed, and this impacted the renewal rate, something like that. So voluntary churn is a lot more indicative of the strength of your product than involuntary churn. Involuntary churn is more of an operational hiccup. that you probably have. Maybe you're not sending email reminders. Maybe you don't have a really good retention team that's helping you out. So as Lai was saying, right, you're counting the dollar amount or the number of customers that started your service, right? And you're trying to calculate how many customers you're retaining. But what is problematic and what's limited in terms of just looking at the churn amount? So let's say, what's a great example? Let's say I have a membership, right? So there's a company called Pipedrive, for example. It's a CRM tool, and it's like a mini Salesforce. Or we could just use Salesforce as an example. Lai has a very successful business. It's growing, and initially he has a small business account. We're just going to call it a small business account. Now that his user base is growing, right? He has to hire additional employees, account managers, account executives, customer service people. So he goes from 10 employees to 50 employees. And because he goes into, now he has 50 employees, he has to upgrade to the enterprise version of Salesforce, right? So Lai is still with the customer, but he's now paying what he used to pay $10,000 a month. Now he's paying, let's say, $30,000 a month, right? Does churn account for that, or does it not? So what happened there? So you still have one customer, and Lai is paying $10,000 before. Now he's paying $30,000 or more because now he has Salesforce Pro, basically. How does that impact churn? Does it impact churn, or does it not? Okay, how many of you guys say it impacts churn? How many of you guys say it doesn't impact churn? Logan? Ahmad? Puya? Yeah, it doesn't, right? Because it doesn't, the problem with churn, you're just taking the percentage that's retained over a course of time, right? So you could take the aggregate dollar amount, but you're not actually accounting for upgrades and downgrades to the software. So let's just assume the opposite, right? So Lai's business, unfortunately, COVID hit. It was a COVID related business. It was in the movie ticketing space, right? So he can't, he can't get more customers. He can't sell more movie tickets, all that stuff. Now he goes back to the small business account software. Is that going to impact churn? It doesn't, right? He's still retained as a customer. So the problem with churn is that it doesn't give you a 360 view of what, how your businesses impact by, money coming in and money going out. So that's the problem with churn. So the more significant metrics is called net dollar retention, right? So this is basically how much money stays in your pocket on a month-to-month basis, given the same cohort of customers. Does that make sense? Is the construction too loud? Can you guys hear it? We're good? Okay, cool. So let's look at the merits of net dollar retention, right? So comparable periods used for calculation ensures consistency, considers effects of seasonality and calculation, easy and simple to calculate and present. I guess downside of it, limited additional variables considered over comparable periods. Oh, I'm sorry. This is the pros and cons of churn itself. My apologies. I gotta fix the title. Does not normalize for impact of upsell or downsell or involuntary churn. So this is the most important part. And this is something that, can you guys bear with me 1 second? We have some construction going on here at my house. Just 1 second. Sorry about this, guys. Sorry about that, guys. So, churn, very easy to calculate. It can account for seasonality. You could do a really good, robust cohort analysis. But the core thing that's missing from, the problem with churn is that it doesn't account for upsells and downsells and voluntary churn. And it just underestimates the impact of churn itself, because it doesn't really calculate how much money is kept in your pocket, right? So this is this is the limitation of churn. So this is why net dollar retention is really important. So before we talk about net dollar retention in just a little bit, this is just another analysis on the impact of churn, right? So each line item represents each cohort over time that's coming in, and see how, if something has negative churn, meaning the number of customers is growing each year, the dollar amount that you can ultimately get after 33 years is exponentially high. Sorry guys, can you give me 1 second? Let me just try to so they didn't tell me they're doing construction today. So just one second here. 1 second. Let me just see if I can change something. Okay, sorry about that, guys. I told them not to do any construction on Saturdays 9 to 12. But I have my noise cancellation headset on, so hopefully this is much better. Is this much better, guys? Wait, hold on.
No difference.
No, how bad is the sound?
I mean,
I think it's okay.
yeah, I think we can live with it.
Yeah.
Oh, really? Oh, okay. Well, it's really loud for me, so that's why. I don't know how loud it is for you guys. I'm like so pissed, genuinely. Okay, so this is the power of negative churn, meaning that every single month you're adding customers rather than losing customers. So as you can see here, after a little bit more than 3 years, you have one business that's generating close to $400,000 in revenue, and another one that's probably at about 150. Even though this is only 2.5% negative monthly churn, and this is 2.5% monthly churn, right? So this is why you see some businesses that have just astronomical valuations, even with such marginal differences, right? Just based on recurring revenue. Okay, so let's look at the equation here, net dollar retention. You have the starting MRR, right? So what is MRR, guys? Like?
Oh, the monthly recurring.
Yep, perfect. Monthly recurring revenue, right? And then expansion of the monthly recurring revenue. So upgrades, right? And contraction of monthly revenue. So downgrades minus the churn, right? And then you take the starting MRR, and keep in mind, this is all dollar amounts, and you times it by 100, and this becomes NDR. So, well, why is this important? Overall, companies with good NDR that is over 100%, they grew significantly rapidly, like this chart right here. So over a course of time, remember Einstein said the most powerful force in the universe is compound returns. This is compound returns. So this is the type of business you need to build, and if you really want to scale. So let me see here. It also shows how sticky your business is, right? So over time, are your customers becoming more and more independent, right, on your business? It basically shows your customers lifetime value and gives insight to the growth of your business. So we'll talk about that more in just a little bit. But in essence, it also catches, right, whether you have any holes in your business or not. So oftentimes what can happen is that a customer in essence could have really bad churn numbers, but the NDR could be incredibly positive, or the churn could be just something like 1% or 2%, but the NDR could be a positive 120%, right? So these are some amazing numbers. If you look at, is anyone invested in some of these stocks by any chance? No, right? But if you look at some of these numbers here, you could see Snowflake 169%. Snowflake is, one of Warren Buffett's favorite companies. Twilio 155%, Datadog 146%, Slack 143%, Zoom 140%. These companies, the reason why they have such high valuations is because of this factor here as well. Looking at this metric, net dollar retention. So what's fascinating about some of these metrics is that you don't find these metrics in financial statements, right? Anyone can open up an entrepreneurial finance book or, typically financial accounting book, but they're not going to teach you how to calculate net dollar retention, churn, do churn analysis, et cetera, which is really important benchmark in terms of assessing, right, the quality of a business. So this is another example, very similar. So if you look at net dollar retention, one has an MRR of 99% net retention, and the other business has a 101% net dollar retention. So as you can see here from this chart, over just a short amount of time, explanation got cut off. One business is substantially greater than the other in terms of total revenue numbers. Any questions?
So the information is not publicly available, right? In case of finding companies like that, the monthly recurring revenue. So because they just say that this is our revenue, they don't say what is the recurring revenue. They don't report that.
It's almost impossible to find. Yeah. I mean, if it's like, if you did like, that's why I think always like what's happening in the real market, right, in the real world is so far ahead than what's in like financial books. Because if you were to recreate the financial statements, right, in this year, like forget about, income statement, balance sheets and all that stuff, there'd probably be a completely new metrics. Looking at like user acquisition cost, right? Or like churn analysis or like cohort analysis, right? Net dollar retention. Like there would be some like breakdown so you get a much better sense of the business opposed to just like capital expenditure, which is, not that big, right? If you're a software business and every business is being a tech business. So if you watch Kathy Woods and some of her lecture, she talks about how financial analysts have such a hard time assessing tech companies because they don't understand tech. They don't understand engineering. They don't understand like software businesses. So what this creates is like some level of arbitrage opportunity where a lot of these potential companies could be misassessed. And you as an investor, if you can find these pockets and understand that, right? Or even as an operator, if you understand what's really driving growth these days, then you'll just have an incredible edge against your competition. that make sense? Okay, that's a great question, Kuya. Any other questions? We're good? Okay, cool. So you have, let's take a look at the LTV to CAC ratio. What's LTV?
Is it loan to value?
No, I guess it could be, but not in a sense of not in a sense of when it comes to customers. CAC. What's CAC?
Capital acquisition cost, maybe.
Customer acquisition cost and lifetime value of a customer, right? So LTV to CAC. So this isn't even a metrics that's focused on recurring revenue, but very important metrics that all your VCs are going to ask, all your investors are going to ask, even key employees in the marketing department. This is the metrics you want them to go by, right? So anytime you're getting a customer, you want to understand how long they're gonna buy fish from you, basically, right? So if you understand a customer, let's say you're paying $1,000, right, to get a customer. So hypothetically, Puya, let's say he starts a furniture business, right? And it's a team of 10 people. Is that a business you want to start? Probably not. Of a sense that you don't want to start that type of business. But let's say Puya spends $1,000, right? Opening up Puya's furniture house, right? And he spends, every time he spends $1,000 on Facebook ads, he ends up acquiring one customer, right? Luckily for him, his furniture is incredibly expensive. Like it's like this antique, furniture that's worth like $2,000 a piece, right? So for him, his business is okay because for every $1,000 he spends, he gets $2,000 worth of revenue. Well, let's say you have to consider the gross margins and everything like that, how much profit margin it is. But let's just say hypothetically, he nets $2,000, right? He sells it for $4,000, he nets $2,000. His business is okay because whatever he spends, right, he's making money off of it, right? But hypothetically, let's say he still continues to spend $1,000 a month to acquire each furniture, but now he's only taking in $500, right? So every time he spends money and acquires a new user, he's negative $500. Does that make sense? Now, in a more complex situation, let's say Puya offers a completely different types of service, right? Let's say this time he has like some kind of box subscription, right? That every time, each month you get like a new set of candy, right? Sent to you. And it's like this very interesting candy that you get every single month. It's like a collection of different candies from all over the world. And to subscribe for it, it costs about $40, right? Every single month that you have to pay for this like really, really special candy. And each time he spends Facebook ads to get these customers, he spends about, let's say, $20 a month, right? And then the customer pays $40. But the problem is his average customer only stays 3 months, right? So in that scenario, what would his LTV to CAC ratio be? $40 a month, three months, right? And then the customer acquisition cost to get that one customer is $20. What would be the LTV to CAC ratio?
2 to 1.
How do you get 2 to 1?
You said it was 40 to 20, right?
That's if it would be 2 to 1, Logan, if the customer just did a one-off transaction and he canceled after that one box. But what if he stayed 3 months, Logan? What would be the LTV to CAC ratio be? 2 to 1. 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 2
6-1.
6-1. Exactly. Exactly. So do you guys see how that doesn't matter what the LTV to CAC ratio is at the time of acquisition, as long as the customer is there for a long time? So where it gets much more complex, I'll give you a very much more complex example. Let's say, right, Puya's acquisition cost was $150, right? And this time the customers stay for about 5 months, right? So his customer acquisition cost is 150, right? But if they're staying for 5 months, right? So his net is only $50. So that ratio is like something like 1.25 to 1. So if you think about it, right, if you account for Puya's salary, maybe rent, all that stuff, you could end up with like a negative, right, operating margins just based off of a really poor LTV to CAC ratio. Does that make sense? Pretty cool stuff, right? So LTV is basically average value of sales times the number of transaction times retention period. Now, if it's a monthly subscription or strong recurring revenue, then you don't really have to look at number of transactions. It's just basically of the monthly fee. Does that make sense? But if you're selling like an e-commerce business, right? So let's say the average customer makes about 5 purchases of Puya's candy per month, right? He just like sells all these candies to sugar addicts, basically, right? And the average customer makes about 5 transactions, and then the average amount that they pay per candy is like $10, right? So it'd be 10 times 5 times 5 months or whatever, right? The duration that they're staying. So that's the total lifetime value of a customer. And your goal in running a business is to increase repeat business, right? So think about like a restaurant, right? Let's say the average value of a sale for each customer that comes in is about $30. And then number of transactions, maybe each customer comes in like 3 times a month. You want to keep them coming as long as possible. It's the same formula, whatever you do, whether it's subscription or whether it's non-recurring revenue, right? Customer lifetime value. This is slightly modified. You're just trying to figure out your take home, your profit margin after you account for the lifetime value of a customer. So this all integrates with margins, lifetime value, all that jazz. Exciting stuff. What is customer acquisition cost, right? So customer acquisition cost of sales plus cost of marketing. Make sure to also include how much you're paying your marketing team or your outsourced team as well. And then also, if you want to get really, really specific, you break down what you're paying yourself if it's a very small sole proprietor type of business. And then you break down, okay, 20% of my salary, I'm going to put into the CAC measurement, because that's roughly how much time I spent on trying to get a new customer over a weekly period. What are some other examples of cost of marketing?
Would like research and research groups be in there?
R&D. Yeah, it could. Yeah, if you're paying a marketing team to do some research, yeah, I would definitely include that. So Facebook ads, right? Flyers, pamphlets, marketing material. So you're trying to figure out, to get a very accurate number. Cost of sales, how much you're paying your sales employees, travel expenses, conventions, all that stuff, right? And you want to see how much you're spending for each CAC. So one of the more interesting things that happened with me was that every time I hired a vice president of sales, the problem with that was that so let's say you're running a sales team, right? You have one vice president, right, that you're paying $200,000 a year, right? And you have 4 college students, recent grads, that you're paying $50,000 a year, right? So the 4 college grads, let's say they bring in like 20 contracts that first year, right? And then the vice president brings in 12 contracts that first year. What's a better deal for you?
College students.
It's a no-brainer, right? Even though the vice president brought in, right, 12 contracts, you pay him 250K a year, right? There's 0.5 contracts per month. And the college students only brought in 20 contracts. So each guy only brought in one contract every 4 months, right? At the end of the day, you just scale up on the number of recent college students, right? Because you're paying so much per each contract, right? Assuming all things are equal, assuming, you know, the number of the size of the contract, the duration of the contract, the structure of the contract, all things are equal, you know, you're way off hiring the college students, right? So this is one of the number one problems that I see on startups. They think hiring a vice president or industry leader that's been in the business for 20, 30 years is the best way to go. But if you actually break down number of employees, or I'm sorry, amount of revenue generated per number of employees, then you'll quickly realize that oftentimes hiring junior guys is significantly more profitable than hiring a senior executive where you have to charge an arm and a leg. Another thing that I noticed is that oftentimes executives that have been in the game for a long time, they just want to play golf and hang out with their friends, and they run out of their friends they want to reach out to. And within a certain industry, let's say, you know, you're targeting a very niche industry. Let's say, for example, remember Sim number 1? We talked about college enrollment software, but it was college enrollment software. But although EdTech was worth something like $20 billion, the specific college enrollment software market, admission software market, was only $1 billion, right? So in that kind of niche industry, you probably have fewer than 100 executives that are really big key decision makers that really move and shake the industry. So in that scenario, hiring another sales executive on top of another sales executive, you're just going to cannibalize each other, because one person probably already knows like 95 people, right? 95 key decision makers. So when you hire the second guy, you're just going to go from 95 to 97. So the best structure is probably bringing in an industry executive, maybe as an advisor, a figurehead, or a part-time individual. And then you supplement that team with just a bunch of like younger recruits to offset that cost, which is you know, really crucial to having you run a successful business. So these are just some of you know, campaigns and I guess like some examples, right? So you can have like a affiliate marketing campaign, you can have a distribution channel where you're delegating to third parties, giving them a revenue cut, for example, if they're expanding into other markets, just sales and marketing salaries, anything kind of like marketing material expenditures. These would all account for your customer acquisition cost. Any questions so far? We're good? Okay. So assessing growth and sustainability, LTV to CAC. So LTV to CAC, so it's basically the ratio of customer lifetime value over customer acquisition cost, right? So if 90% customers retained per year and profit contribution is $100 per year, then LTV is 100, you know, divided by 0.1, you take out the churn rate. So then that's $1,000. On average, we'll make $1,000 over the course of the customer's life with us. $100 in year 1, it's 90 in year 2, plus 81. So each year, you're getting what do you call it? 90% is decaying, because your churn rate here is 0.1. So you're retaining 90% over time, right? Customer acquisition costs, so you have total marketing, sales, and onboarding costs, number of customers acquired over the same period. If you spend 100K in ads, 100K in salespeople, and 50K in client services to onboard, then you add all this up, right? And then it comes down to $250 per each customer. And then now you have an LTV to CAC ratio of 4, for example, right? So this could change from period to period, monthly, quarterly, yearly. And why is it important? Well, you want to see if your customer acquisition funnel has a really, really good and sturdy ratio, right? Now, going back to our dilemma when we were using Puya's example, this doesn't necessarily account, right? Just this alone doesn't account for some of the changes that could happen in the future. So there is still a limitation for that where you need to kind of predict, something like COVID, right? Could adversely impact it, or after a certain point, the product could kind of plateau in the market. There could be entrants that come in to kind of disrupt the market. But this is still a pretty sturdy baseline and a very, very common metrics that used in Silicon Valley, as well as private equity, as well as that's used with any kind of operator that's running a business. Generally, the simple rule of thumb is that LTV to CAC ratio, if it's greater than 1, you're in great shape. You're creating value, right? You're adding value. Your business is growing. If it's less than 1, you're in bad shape, simply put. So over a course of time, you want to be able to be in a situation where your customer acquisition cost remains stable, right? Hopefully this grows. And if the churn rate, if you have negative, if your net dollar retention is above 100%, right? The lifetime value of your customer will extend, right? And your LTV to CAC ratio could potentially improve, right? But sometimes what happens is that when you're launching a new subscription business, the problem with that is that you don't really know the full lifetime value of your customer. Does that make sense? So let's say hypothetically Luke, right, just launched his business, and it's actually a business where it's a shoe subscription. So it's called, Luke's Shoes, right? And he just started a business. Enrique, Ahmad, you guys all love the shoe. It can make you jump higher, run faster, and run longer, right? It's just the most amazing shoe ever. But they've only been around since Luke just launched this business in January of 2021. Luke, right, Enrique, and Lai, they have yet to cancel the product. And Luke only has 3 customers, right? Hypothetically, right? So in this scenario, he cannot calculate the true lifetime value of a customer, right? But let's say, hypothetically, Luke brought in Ahmad, Enrique, and Lai. And then Lai said, this stinks, So after the first month, he just canceled, right? But Enrique and Ahmad, they're still holding on to that subscription, right? So they love getting new shoes, one new pair every single month. So they're about 7 months in now, right? So you have 1 customer that canceled after 1 month, 2 customers that are still around, but that number is skewed, right? Against Luke, right? Because we still don't know yet if Enrique is gonna stay for like 50 months, or if he's gonna cancel after month 8, right? Same thing with Ahmad. We don't actually know that number. So in a growing startup, for that LTV to CAC ratio to balance out, it's very hard to extrapolate that data. And there's a whole different art and science behind it, but that is the limitation of it. If a startup is relatively new, there's not enough data to backdate to predict that. So the best way you could do is understand the trend. If you're understanding the trend and if it's going through a positive direction, then you do some cohort analysis, right? Then you look at the net dollar retention. Then you look at the logo churn, right? You're going to get a really good assessment on how the business is doing. Does that make sense, guys? Okay. Any questions so far? Okay. Perfect. So let's look at some of these numbers here. Okay.
So LTV less than 1, LTV to CAC numbers less than 1. You spend $1,000 to make $900 over the lifetime of a customer. Does this sound like a good deal? Spending $1,000 to make 900. Horrible, right? A lot of startups, when they first start, they try really hard to make their numbers look good, inflate their numbers. So if you become an angel investor, like you have to look through this carefully if you can. On the flip side, a lot of founders and entrepreneurs, they're like in denial, because they keep believing that eventually the product is going to fit the market so that it'll even out. And it's very hard to tell the first year completely, because you don't know if enough customers are going to stick around with your product, right? So that you can scale. You think eventually if you fix a couple bugs, or if all the people who don't like your product just fall out, your LTV to CAC ratio is going to improve. But so many startups fall into that trap of pouring more and more and more money in, and it just never goes anywhere because they never ever find product market fit. And this is a really good indicator of finding out pretty quickly, if you use it right, to see if there's any potential. If LTV to CAC is larger than 1, you're in great shape. VCs and PEs target LTV to CAC ratio that's greater than 3. This is because it's not just about acquiring that customer. You have to cover rent, insurance, product team, engineering team salary, all that stuff. So do you guys remember the metrics that we talked about with the sales acceleration formula with Mark Robles, the MIT engineer that was the worst engineer, so he had to come up with the sales acceleration formulas? Remember that? What was the ratio between revenue over sales employee salary that he said that you should hit?
3.
3 to 1. Yeah.
3 to 1, right? Yeah. So it seems like it's always that magic number. So that's like the minimum I like to see. So this is pretty aligned with the long-term value of a customer over CAC. So this is just, a couple examples of churn, right? So we talked about this, but LTV over CAC isn't everything, because if one business, scenario A, has a churn of 20%, 70% contribution margin per year, right? 20% of that gives you, right, $350 in LTV. And then you spent almost $117 on CAC, right? And customer acquisition costs. And the other business, right, you have churn is just 5%, $70 contribution margin per year, 5%, divide that by 5%, right? $1,400 in terms of LTV, right? So remember, you're taking, in order to find the LTV, you take the contribution margin per year and you divide it by the churn, right? So it's the opposite of calculating the retention every year. You just divide the churn instead of calculating the retention rate every year. And then you spend at most, let's say $460 on CAC. Well, what is better, right? Well, if you take your net dollar retention, it's larger than 110%, and the gross margin is 70%. For a $100 product, LTV equals $70 a year, $77 in year 2, 84.7 in year 3. So this is basically infinity, right? So what we're trying to say is that if you have a business, hypothetically, that has a positive net dollar retention, and it keeps growing every single year with a positive gross margin, then after a certain amount of time, in essence, because the customer base is continuously growing, your net dollar retention is in theory an infinity amount. It's just continuously growing one after another. So if you can understand, going back into this, understanding net dollar retention, you're going to be able to create a business scenario that's going to look, let me see here. And like this, right? You're just continuously growing at a rapid rate because your customers are just using more and more and more of the service. So this is where the LTV to CAC ratio has to work and tie in with the net dollar retention, which has to tie in with the churn to really understand how quickly the business is growing. Okay, does that make sense? Okay, cool. So going over here, right? If you're looking at just the LTV to CAC ratio, we talked about some of its flaws, right? You don't understand how quickly these customers are expanding the products and services. You don't understand. It doesn't really break down like the payback period of the software, right? So there's still certain blind spots that you need to overcome. So when you start baking in different metrics, you get a more full insight into what this could entail. Let's take a really quick break. I'm getting really like thirsty. So would you guys like to reconvene at 10 o'clock? Would that work? Okay, awesome. Okay, bear with me, guys. We're almost done with the quarter, and we're rounding out the lecture today. Okay, so let's talk about payback period and very simple metrics. Does anyone know what payback period is? Just find it right here. What do you guys think it is?
The time allocated for a customer to give you money.
It's basically the time period needed, right? To break even. So it's like a break even analysis, right? So payback period formula is the initial investment or original costs of the assets, right? Divided by cash inflows, right? So this is really important, not just when you're pitching to investors, but this was a very typical formula where you wanted to like I used frequently to convince customers to buy a certain software. So if I tell them, oh, it's going to cost you like $5,000, then when are we going to break even? The customer's going to ask, well, if you're with the software that's cost $5,000, you're going to make about $1,000 each month. So their payback period would be 5 months, right? So you're trying to figure out what that time period is, right? So if the cash flow inflow is infinity, it could, come into a certain amount that it's a very, what do you call it? In theory, it could come into like a very small number in terms of the payback period. But what you're trying to figure out ultimately is just the time frame, right? Where the payback period is, where you're just trying to figure out the time frame of when you as an investor or the customer is going to be able to pay back for the cost of purchasing that software, or I guess like breaking even on that initial investment. So it's a very simple formula, and the advantages of it is that it's easy to calculate, easy to comprehend, easy to analyze. Very good indicator of liquidity of a project. So basically, if there's no cash flow that's coming in, then you're not going to know, right? But most of the time, when you're kind of assessing these types of projects, you're going to try to figure out the cash flows that's coming in order to understand what the payback period is. So because you're focused on those types of projects, generally speaking, it's a pretty good indicator of understanding whether the project is good or not. It's also really good metrics from what I understand. If you're trying to compare like two different sizes, right? So if you're trying to look at two different investments, one gives you a significantly greater amount of cash inflows, even though, right, it's a much greater investment, right? So if something's like $50,000 as a project that you're initiating, let's say you're investing in a particular project, you're bringing in $10,000 a month, the payback period is still 5 months, right? So sometimes if you're debating with the customer, right, well, why would I go with your software that's worth 50,000 versus the competitor that's 5 months, but the cash inflow that's coming in is about 12,000 a month? You could just tell them, hey man, the other one, the payback period is 5 months because it's $5,000 to start the project and the cash inflow is $1,000. But my software, it's 50,000 and you're going to generate 12,000 a month. So your payback period is actually better. So you're better off with project B, even though the initial outlay is significantly greater. Does that make sense? So it's like a quick and dirty way of using something like this, or it's a very quick and dirty way of being able to convince people that one project is better than the other. Some of the disadvantages, I mean, it totally disregards the time value of money. It has sometimes unrealistic expectations, does not consider the cash inflows after the original investment. right? So this is not part of the that's one of the disadvantages, because once everything breaks even, it completely disregards any future input. Bias against long-term projects that take longer time periods to become lucrative, right? So yeah, because of that same factor, it doesn't really account for anything after the initial money, right, is made back for that particular project. So these are some pros and cons. And now the next step is trying to integrate, right, measuring sustainability with customer acquisition payback period, right? So you're taking the number of months it takes for a customer to pay back its acquisition cost, and then you come with a reasonable estimate, right? Customer acquisition divided by MRR, monthly recurring revenue, times the contribution margin. A more accurate estimate is to sum up the MRR times the contribution margin each month until you equal the sum of the customer acquisition period, and then the number of months equals the payback period, right? Now, why is this important? Well, it doesn't give you the complete picture, right? LTV to CAC. You want to just understand how long it takes to break even on the software, right? You're trying to figure out, like, what is the payback period for that initial investment that you made? So why is this important? Well, if you look at let's say, like going back to Puya's subscription box, right? Or Luke's subscription box of shoes. Well, you create the initial website, you create the initial software, or let's say, Puya created an app for his furniture or whatnot. What oftentimes is that when you're starting to scale, the initial fixed costs of creating that software and that infrastructure, that impact of it diminishes over time, right? So it's not only that, sometimes you train your marketing people or your salespeople over time, they get more and more and more efficient, which is lowering your customer acquisition time costs over time, which naturally impacts your payback period for every single project that you're initiating over a course of time, right? So if you look at the dynamics of, I'm just going to skip here real quick. If you look at the dynamics of a bootstrap company, and we're just using SaaS for example, because usually with SaaS, if you're, for example, white labeling a product, you're just copying and pasting the code every single time. Let's say you have like an app agency, and then you're helping companies launch their own, let's say, clothing app, right? Because that's what you focus on. You're focusing on creating an e-commerce business, and you're just changing the logos and the brands. And every single time you do that, your variable cost is it's bare minimum. It just barely fluctuates because the initial investment that you created, right? It goes up all up front, and then over time, you don't have that much overhead to recreate all those apps. So you go through a phase where you have a really high burn rate because of your finance needs, and then over a course of time, all this is just positive EBITDA margins in essence, right? So, why is this important, or what is it? We want to just understand how cash is consumed over time, and how much change there is, how much working capital is needed, how much cash is needed as you scale. And it's very important to understand, like, at what stage your company is in this life cycle. And going back to some of the exercise that we did, you can also bake in your assumptions on TAM, SAM, and SOM to really understand how far they're at. So when you're right here, right, for example, you might think the market has plateaued because your TAM, SAM, and SOM is significantly smaller than what the founders suggest. So at here, you don't know if it's plateauing here, or you don't know if it's plateauing here. You don't know if it's plateauing here. You don't know if it's plateauing here, right? Does that make sense for you guys? So when you're baking in market analysis, you want to potentially readjust this based on your assumptions on the industry size. Any questions so far? No? Okay. This is, very similar. So, I think I explained this already. So as companies start to scale, is anyone familiar with burn rate from the video? Right, Puya, what's burn rate?
So it's the money that you are losing divided by the time period that you're losing it till you get to profitability.
Yeah, basically, right? How much money that you're burning through each month. That's basically what it is. So oftentimes this doesn't just apply to SaaS, right? We're taking a SaaS as an example because there's a very strong recurring revenue component to it. You start with all this financing in the beginning, which puts you at negative or not negative, like a high burn rate. There's a break even point, and then you start to scale. This is where all the EBITDA margins come in. This is where SaaS companies get really, really expensive. And remember, we talked about the rule of 40. So generally in SaaS, you take the growth rate of a company, you add it with the EBITDA margin, and you see if that equals 40 or higher. And this metrics became so prevalent. Now they're also using it, not just for SaaS companies, but to look at, professional services on all these different businesses as well. Because if you're not growing quickly, then you should at least have high growth, high EBITDA margins. If you don't have good EBITDA margins, you should be growing quickly. So that's the assumption behind it. And you want to make sure that checks out at least, 40. So it's guys, this is really, really tricky because all these metrics, right? It's not like there's no one silver bullet, because certain industries and certain spaces and certain business types, like for example, the LTV to CAC ratio might be significantly more important, right, than net dollar retention, right? If a company doesn't even have a, different type of product variety, if it just has one type of product, maybe you just have to look at churn. Maybe net dollar retention is not the answer. So you as an entrepreneur, you have to figure out what metrics work for your business, right? You just have to pick and choose what key KPIs. They call this key performance indicators, and you need to figure out what KPIs work for you. So when you talk to investors, you focus those KPIs on you focus those KPIs that matter to you most, not based on what everyone else says, right? So those are the things that you have to remember as an entrepreneur. This is just another example, right? So really quickly, this is the initial cost, right, of acquiring a customer. Then you have the subscription payments to figure out, how it normalizes over time, how you pay back, you pay back yourself, right, after customer acquisition cost, with the subscription payments over time. And these are just, general cash dynamics, right? This was how it would break down on a monthly basis. So in the beginning, you're looking at a single customer, like you're spending Google ads, Google ads, Google ads, Google ads, and then, you acquire the customer, you're traveling, you set up some meetings, and then over time, it hopefully diminishes along with the cash flow that's coming in from the subscription payments that are coming in. So over time, the goal is for every single customer for you to offset the initial outlay, so that through that subscription, you're able to make positive returns. So, the goal is that, as we add more customers faster, cash flow may be deeper than if we added fewer customers slower. What would we assess to figure out if the cash burn is sustainable? So at the end of the day, if you want to be able to accelerate, you want to be able to remove any type of like bottleneck, so that you could add customers faster and faster, so that you're not at the lowest point, right? You're able to grow out of it as quickly as possible. So the faster you're able to accelerate, the more you're offsetting that trough period of where you're at negative cash, essentially. So when it comes to SaaS, like oftentimes the reason why this is important, when you look at the rule of 40, if there's no EBITDA margins and you're just barely breaking even, if the growth rate is quick enough, investors are actually happy with that. And that's a core metrics to look at. On the flip side, if the growth rate is incredibly slow, they want to make sure you have positive EBITDA margins to offset the cash burn. So oftentimes you see these ridiculous metrics. So one quick example is that if you looked at a company like WhatsApp that got acquired for Facebook for $19 billion, they only had 50 users they only had 50 employees. So their revenue per an employee was just off the charts. If you saw that transaction happen. And so much of that was forgivable because the growth rate was so crazy. They were able to slap on such a high valuation, even though it was not a profitable business. So that's why you see these absurd valuations because of such, peculiar metrics that's happening. So these are just, additional, stuff that's happening. I'm going to skip this. You guys could look through this when you guys get a chance, but it's mostly pretty much the same topics that we're talking about. One thing that you want to know is that it takes time. So when you're over here, you don't know if you're going like this or you're going like that or like this, right? So one of the key things that you have to focus on is just understanding like net promoter score, customer engagement levels. If you're, for example, like running a online business, like an e-commerce business, you want to see your web traffic results, how actively are your customers engaging on your social media posts? How often are they logging in? One of the things that was really crazy and Sean Parker did a really good job on when Facebook was initially taking off, even though there weren't any core metrics that were established at that time, the amount of time spent when customers or when users were on Facebook was just off the charts. So they were talking about how this was like crack, basically, because all the students would just keep logging in and we can engage and like constantly be on Facebook. So the user activity was just astronomical. And that based off those metrics, they were able to come up with such a high valuation for Facebook. So I forgot who it was. I can't remember. It was like Yahoo or Google. Like they tried to offer like $70 million for Facebook initially, and then Zuckerberg said no. And yeah, now look at where they're at. So other stuff to look at, customer NPS score, how likely you would recommend. Another great indicator that I forgot to include here is potentially referrals, right? How often are your customers referring other customers? That's also a really good indicator of how well your customers are engaging. And also you can look at like win-loss ratio. Win-loss ratio is when you're trying to assess how often you lose your business to a competitor. So sometimes you can do surveys, or if you train your sales guys really well, maybe you can have them do follow-up calls to understand how often that you're losing to a competitor, and that will give you a pretty good assessment on where you're at. But all in all, it looks so easy if you look at these charts here, but at the moment you're in it, that's what separates a good entrepreneur from a great entrepreneur. Okay, we covered a lot today already. Any questions so far? No? Okay, so let's cover some more easier stuff here. We're gonna go over managing startup financing. I really like this lecture because they keep it pretty simple, but it's so important that we understand some of these things. So early stage pitfall number one, not knowing numbers. And the video talked about 3 different numbers that you should be really familiar with. Can anyone help me out here and mention those three? Lie?
Is it the bank balance, money going in, and then money going out?
Mm-hmm. And what else?
Growth rate?
Yep, growth rate. And then there was
There's burn rate as well.
mhm.
Then I think defaults, whether or not they were profitable.
So there was, let me see here. So growth rate and then runway, right? So burn rate, money going in, money going out, run rate, and then growth rate, the three things that they focused on. So let's go back one, let's go do a really quick review. What is run rate, right? So if the bank balance is 300,000 and then you're burning 25K, so this is the burn rate, monthly burn rate that is, then this basically means you have 12 months left to survive, right? The other one is month on month, stand for, what does MOM stand for? This is the monthly revenue rate. So you want to be able to know the growth rate, right? So the three stages that you should think of, like, burn rate, money out, money in. Thank you, Live, for that. And then runway, your bank balance divided by the average monthly burn, and then your growth rate. If you know those three, then you have a really good sense on how well your business is doing. Did anyone get a chance to check out this this site? Okay. So let's, for example, talk about let's say Lai's business, right, is spending about $1,000 a month, roughly, right? And on the only thing I don't like is like this is weekly. Can I change this to monthly? Oh, yes. All right, let's change it to monthly. So Lai is spending about 3,000 a month, right? And then his monthly revenue is about, let's say, 1,000 a month, right? And you're growing. How quickly do you think you can grow a business, Lai? About
Yeah, 5%.
5%?
Yeah.
Month over month. All right, this is a great business. I should invest in Lai, right? So you could see here, to bridge this gap of spending 3,000 a month, he's going to need about 25K in capital until he breaks even at your 1.8, right? So like if you come up with a business where you're only spending 3,000 a month, but you're growing at a little over 5%, right? And you're generating revenue at this rate, you'll break even at 1.8 years. So you only need 25K for this business. This is a pretty cool tool. I mean, you can change this to, I guess, like an annual amount as well. Yearly, here we go. And I guess like you have a yearly expense of, let's say, let's put some bigger numbers here, like 300K. And then you have your start initial revenue is, let's say, like you're really bad. And then 25. Ooh, I don't even. Okay. I guess I gotta increase the growth rate to make this chart work, for at least for now. But you're growing like 500% per year. So you're gonna have to raise like close to 600K to break even. But this is so important because I remember I had a couple of fraternity brothers that came from UC Riverside, and the first thing that they spent was a logo. So they spent $20,000 on a logo, and within like 9 months they ran out of money because they started like their own boba shop. This was in 2005, or no, not just a little after that, like 2008, 2009, and everyone was really excited. I mean, for 50 grand, the logo was like, okay, but they spend money on a logo. They buy, all these like, expensive, I guess like furniture, and they were excited about this boba shop, but they basically ran out of money before they could even like break even, right? So you want to understand these core metrics and just figure out like how much capital that you need. And I kid you not, so many founders are so obtuse in terms of how their money is being spent. And it's hard because, you know, it's like sometimes your personal life, you get so busy, you don't manage your credit card bills, you forget all the subscriptions that you signed up for, you forget to cancel them, and things can accrue rather quickly. But if you have just a really good pulse on what's going on, this is going to really help you fundraise. And nothing turns off investors more than a founder that doesn't know their financial metrics. So what were the two things that we always talk about that are the two most important things when it comes to financial modeling? Does anyone remember?
I know cost was one of them.
Yes, cost. And what's the other one?
Time.
No.
My bad.
No, that's all good. Assumptions, right? Your costs and your assumptions, because cost is something that you can manage, right? And assumptions is how you build the model. It's all about the assumptions, not about plugging in the numbers. That's why I always talk about like footnotes, guys. So if you could just come up with, if you understand your cost, right, you're already halfway there. But the next part is figuring out your growth assumptions. And the only way to do that is to really understand your metrics. I wish I knew some of this, like when I was doing my first couple of ventures. I think I would have had a more victorious outcome. But nonetheless, I'm still young and I'm still here, which is great. So these are some of the, you know, pitfalls, right? Not knowing key metrics, getting too busy and not checking your balances, right? Just kind of running around, doing your own thing, not knowing, you know, what's going on. Underrepresenting expenses. I also like to say underestimating expenses, hiring mistakes. What did the video talk about in terms of like hiring? And, you know, what are some of the things that they talked about in terms of, you know, people like forgetting when it comes to, you know, hiring and costs related to hiring? Yeah, Lai?
It says that hire people is not just their salary. There's stuff like office equipment that goes with it, and then they also assume paid acquisition remain constant.
What about training costs?
I mean, training
Training.
costs is also, people underestimate that. And then I also think they mentioned how people revenue per employee is more important than the number of revenue.
Yes. So the video also talked about most really effective startups. They're able to pack a really mighty punch compared to their weight class, right? So you wanna be very cognizant of how your time is being spent. So for me, right? I'll just kind of give you a really quick example, guys. I think you'd appreciate it. So every person I bring in now, this is right now I'm actually doing this when we recruit interns, but we have a whole entire system, and a lot of small business owners, they do such a poor job of assessing like who are going to be the potential like rock stars, right? So for us, when we recruit, I train my managers like, hey, you need to like break down what the characteristics are of every single candidate. So they get like a pre-workbook assessment, and they have certain skills that we look for, right? Analytical skills, writing skills, domain experience, resourcefulness, preparation, interview, and commitment, right? So all of them are required to give us a particular score. And then normally, they're technically supposed to put a total score down, but we reject people that don't meet the minimum. Like this person is just 777. So obviously, I guess he or she didn't make the cut. But we look for nines, and then the interview is spent verifying whether a nine's a nine or a three's a three. And the reason we do that is to maintain efficiency and to include neutrality when assessing hires. Because what happens is that if you have a bad hire, you have to teach them over and over again the same thing, right? But normally what happens is that if you bring in A players, they teach other people, which continuously reduces overhead. And over a course of time, it's just like churn, like, and that dollar retention, your productivity per worker expands so much more just based off of that, bringing in the right people. The other thing that we do really well here at Founder Legacy Partners is that we call this asynchronous meetings, and we'll record a lot of our videos for training, right? So these are just like general training videos that we have, meetings, etc. So that interns are able to train themselves, because I'm trying to strike 20-30 million dollar deals. I can't waste time like training interns all the time, right? Especially if it's the same thing over and over again. So we have a bunch of training videos that the interns can access anytime that they want. There's another Google Drive just on different training video stuff. So this is not even the whole thing, but we call it the do-it-yourself internship, so that you train yourself and then you circle back for the questions that you want to ask. So a lot of people fall into this trap of constantly training their employees, doing management meetings, doing one-on-one coffee chats. If you run a really efficient organization, I don't think you really need that. So I even when I was running my startups, I would almost never have one-on-one coffee chats and all that stuff, because the performance just speaks for itself. Like you don't need to do that and constantly do all these check-ins, like creating all this overhead. So every organization is slightly different, but you have to figure out how to reduce as much overhead as possible. There's other simple stuff that I like to implement, like for example on Slack. I always try to enforce, and it's just really hard to enforce sometimes. People to not just DM someone directly, but include one supervisor above, so that you never end up playing the game of telephone, where one person says this and then it's slightly tweaked, and then like the third person is saying something slightly different. It could just be never ending. So that's like another important thing that we try to mitigate here, as well as my previous ventures. Assuming I'm sure you guys heard of like hiring slow and firing quick. So that's pretty much something that I've always done, because I know like a bad employee could really drag down the efficiency of a company. I mean, it's just what normally happens is that B players love C players, because B players really care about they don't care much about their performance. They care about their positioning and getting a nice stable job and just like maintaining B player status. But A players normally like A players. That's the problem. So B players, while they love C players, A players don't even like B players. So normally if you get A players, generally they'll attract A players because they're just not as common. And I would say maybe like 2 or 3 out of 10 people that we recruit are A players, and then 2 or 3 are B players, and then 2 or 3 are like C players, roughly. So it's like 3, 3, and 3, roughly. And then normally what happens is that as far as interns go, the 1/3, they're taken out pretty quickly, normally within 3 months. The B players normally will get an extension, and then the A players get to be part of the leadership team, which could potentially lead to an acquisition. In terms of, I guess, like, people on the sales team that I've dealt with, pretty similar, but the difference is that normally a really good sales guy would have like a very outsized return. And there's certain occupations where performance is very easily measurable. But for example, like an operations person, right? Or let's say a customer service person, or sometimes even a developer, it's very hard to track certain metrics. So you have to come up with different types of KPIs to keep them motivated, and then reward some of the high performers, so that your organization continues to evolve and get better over time. Other stuff, I mean, assuming paid acquisition is constant, this is something that the video briefly talked about. This could change. This could be a variable cost, right? Sometimes there's seasonality. So let's say you're, selling Christmas gear, right? Or Halloween costumes, for example, right? So your customer acquisition cost might be significantly lower than selling, Halloween costumes in like February. Right? It makes no sense to sell them, right? Outsourcing responsibility, I think delegating is key to success, but even your leaders, even if they're A players, if you don't engage with them on a consistent basis, even they could get sloppy. So I always go by the mantra of like trust but verify. That's really, really important. Scaling too quickly is another problem. You don't want to grow too quickly or add too many employees at once where they're untrained, because your efficiency might start to dwindle significantly, and you realize like, oh my god, we didn't even have to hire that many people. It's just everyone's not working because there's so many people now. So you want to make sure you have a really good pulse. I really do like the basically the revenue per employee metrics. I think that's a really, really good indicator. And the biggest problem that I think this pertains to fundraising, right, is that letting runway get too low before fundraising. And I see this over and over again. I hate it when entrepreneurs or students that I've taught before, or business school colleagues of mine, they hit me up like 3 months before they're about to run out of money. I'm like, dude, you're supposed to build relationships with these investors, because when investors sniff even like one iota of the fact that you're going to run out in 3 to 6 months, like why would they invest in you? Right? They don't even know you. They just know you through an email. And I see this over and over and over again with entrepreneurs. I just don't understand. Like I'm setting emails out to people who are really well established in the PE firm, and I'm doing it like way in advance before I even know what company I really want to buy. So I get so confused and frustrated about not building that rapport with a potential investor or potential advisor or river guide ahead of time. So I think the quickest way to hedge this, or the easiest way to hedge this, is just to provide monthly updates on a few group of investors that you really want to engage with and build a relationship with. And then oftentimes, if you just provide updates, I've noticed they'll call you or they'll comment on your email and give you any type of feedback. And that organically builds a relationship. So there's no reason to kind of force the relationship abruptly. Building true and genuine relationships take time. So yeah, any questions about pitfalls in terms of like managing startup financing? Nope. Are we good? Okay, cool. So I'm gonna give you guys 20 minutes today, or a little bit more if you guys want to stick around, on trying to figure out your VC and PE project. So I'll just leave it open for you guys to ask questions. So I'm gonna create breakout rooms, and you guys could get started. Did you guys need help? Priya? No. What, you guys good?
Hey, guys.
Hi, Kevin.
Hi, Professor.
Mm-hmm.
So the question we had is not relating to the PE fund, but the syllabus says there's supposed to be a case study. Is that still
Mhm.
happening?
Mm-hmm. Yeah.
Okay, because you didn't
For
mention
Friday?
it. You didn't mention it. So
Oh, do you
It's-
guys not want to do a case study?
just to clarify, the case study will be due Friday, and then our presentation for the PE fund will be due Saturday.
Mm-hmm. That is correct.
Okay, good. Just making sure because we didn't hear from it from the class, so we didn't know that was still happening. But
Oh, okay.
Um,
Yeah, yeah, I mean, it's gonna be a like really quick brief, like one of those Harvard Business Review case studies.
Oh,
Okay.
okay.
Yeah.
and then for our PE fund, we are going with fintech, which hopefully is not too similar to the other example one that you sent. It's
Oh,
fine, right?
Oh,
yeah,
art.
yeah.